today. It's our first Now You Know webinar. My name is Michael Van Laer, but I'm the president and founder of New Outlook Wealth. So New Outlook Wealth, affectionately known as Now, will be hosting a monthly webinar featuring topics we hope will be of interest to our clients and to the broader community. I know we're all very grateful for your participation today, and we hope, I certainly hope, that you will find value in this session and consider sharing the recording of this webinar once we publish it on YouTube later today, assuming I don't botch it up completely. Before we get started, I wanted to take a moment to thank our presenters and panelists today. So on the real estate side, we have Mandy Brown from Royal LePage Dynamic Real Estate. On the, and Mandy, wave and say hello.
Hi, thank you.
So everybody knows who you are. On the mortgage side, we have Chad Wilson and Jason Robertson. So Chad. Hello, Chad.
Chad, you're supposed to wait.
And Jason.
Hello, thank you.
From Ideal Mortgage Solutions. And on the insurance side, we are getting them to join right now, I think. And we have Tara Elias and Jessica Johanson will be joining us from IA Financial Group to talk about the mortgage insurance side of things as well later on in the presentation. So our agenda is pretty straightforward, which is the way it should be. We have about an hour together today. And if our attendees need to leave earlier on, that's perfectly fine. Like I said, we will be recording this session. It is being recorded rather. And with about 50 minutes for each presentation followed by Q&A. So I ask if you're attending this session, if you have questions during the presentation, post them in the chat box and we'll monitor that chat for questions as we go along. And I will pose those questions and rudely interrupt everybody to get those answers as we go along. So hopefully that'll work well. And if there's any challenges or obstacles, I apologize in advance, but it should be good. So with that, let's get started. So I'm going to pass the baton to Mandy right away.
Do you have it?
Yep, we do indeed.
Okay, perfect. So I'm Mandy Brown. I'm a realtor with Royal LePage Dynamic, like Michael had said. I was just going to go through a little bit of stats today, just because I know that the real estate market has been pretty on fire lately. We're in a little bit, everybody keeps talking about unprecedented times, right? And it's still just the market's really, really strong as a seller's market anyway. So this is just a little bit about me. I've been in real estate for about 8.5 years now. Most of my business all comes from repeat and referrals. I've been with Royal LePage Dynamic my entire career. It's a great company. And I do believe I owe a lot of my success to working with them. There's over 100 agents in my office with many years of experience. So together we all sort of help each other, which is not, I think, common in real estate. And then, yeah, so that's just a little bit about me. The next one, buying a home in 2021, which I think is part of what you guys really want to know about. And this is just the things that I sort of put out as the most important facts. Number one is making sure you're pre-approved. I think you just want to know how much you have to work with. I know, and then the next one I put is understanding your finances. And I think those two do go together because knowing how much you can spend and then just knowing how much you're allowed to spend are very, very important. Sometimes maybe you can spend that $5,000 more to get your dream home, or maybe you're looking in a different price range and we need to readjust the expectations. My third thing that I said was hire a realtor you trust. I think that when I'm working with clients, we have a really close relationship and you need to trust the person is working in your best behalf, that they're sending the comparables that you need to see so that you're making good offers, especially in today's market. That being said, sometimes the comps aren't really helpful in today's market. We'll get to that a little bit later. I have a lot of clients that will say, you know what, I'll live anywhere as long as I find the right house. And that's usually not true. So I think knowing where you want to live is super important. I put in here, you can change a house, but you can't move it. And that's really important because if you can hone in on an area, then all the houses that you're looking at are in that area. You're seeing what they're selling for. You're learning your market. I'm big on education throughout the process and learning as much as you can so that when you do buy, you're buying with confidence and you know what you're getting, you're happy to get it. Then knowing what you want in a house and if that's achievable in your price range, and that kind of goes up and is tied into understanding your finances and making sure that we're looking at the right houses for you, and then being prepared and being persistent, and really most importantly buying a home in 2021. You're going to need to have some patience. This is a tough market for buyers. I ran some quick numbers this morning, and in the last week, 77% of the houses that were listed sold for over the asking price. So it's a competitive market and a bit of a challenge for buyers for sure. This is just what I'm going to talk about now, the market. So last year, obviously, we hit some all-time highs in sales and dollar volumes. And then I'm going to focus more on February because I prepared this a few days ago and I had all the February stats. So today being March 31st, so I'm going to talk a lot about February in this. I hope that's okay. So February, the sale prices were up 14% over the same month last year. And that's so also important because that's right before the pandemic hit. So the first thing we're going to talk about is detached home sales. So this is just the average sales, and I took the February numbers and then I compared them to February 2020 so that we could see the contrast and the difference in the two markets, because we have really increased. So you can see this year there was way less active listings, but more sales, which is part of what's driving the market right now. So I think that's shown with the numbers here. When we look at the active listings in February of 2020, we've got 2150, and then the active listings this year was only 1,032. Also, something that's been interesting with this higher sales, less listings, the dollar volume's gone up quite significantly to 360 for the average sale price, whereas the average size consistently has stayed the same through all of the months of the previous year. February 2021 had a 67% dollar volume jump, which it's big. And then 9 days on market for rapid turnover. So it's been pretty crazy. I put three listings here that have sold that were in the average price range. All three of these did sell for over their asking price, and they were nice homes. But it's been interesting. The one in Windsor Park, it was really cute, but it was only 800 square foot, 2-bedroom bungalow. So next is attached homes. This has been really interesting to see. I have a couple of clients that live in side-by-sides, and they're loving this because they've taken quite a big jump in value as well. And the sales have gone up quite a bit. I think because of the lack of inventory in the detached homes, a lot of people have been moving to attached homes this year, which is interesting. So active listings in February, 109. Active listings last year was 198. But then look at the sales again, 66 in February of 2020, and then 91 this year, which has again bumped up the dollar volume to 308 average sale price, and last year it was 278. The next one that do you guys have questions?
I have a quick question, Mandy. Do you think with March numbers coming out, well, in a little bit, do you anticipate a big year-over-year difference because that's when the pandemic would have really hit the real estate market a little bit?
You know what? It's actually not that different. I do have a little breakdown at the end of March. So it wasn't as different as I anticipated. The dollar volume's up for sure. And there is a lot of increases, but it wasn't, the number of sales, I was surprised, was not as different, because I personally felt like I was retired for the month of March last year. I haven't had that much free time since starting real estate. So I was surprised that there were as many sales last year as there were. But I guess because until March 13th, we were having a record-breaking March, and then everything shut down. So it all happened in those first 2 weeks.
Okay. Cool.
So did that answer a little bit?
More.
So then the next thing that I was going to share was just the condos. So I get it's pretty much the same across the board, right? So we had a lot more condo sales. Condos are kind of the exciting thing for me personally. Condos have been getting a really bad rap over the last few years. And the sales are actually it's getting better for the sellers of condos. So we had 170 sales in February 2021 and 116 last year. And the dollar volume on average has gone up a little bit. So condos, I think it's very exciting. I'm glad to see that those sales are coming back around. And I think that is due again, similar to the attached houses because of the lack of detached homes available. And people wanting to take advantage, obviously, of the low interest rates, right? So here's where I kind of tried to break down just residential resale. 654 stats. This was as of a couple of days ago. Average size pretty on par in that 1,300 to 1,350 range. The average price for the sales was $393 and average days on market 12. And then I just put the highest sale price and the lowest sale price. Since March 21st, 77% of the listings have sold for over asking. But I did want to add in too, like, I think that it is starting to even out a little bit. I know that it's very discouraging sometimes for buyers when they're hearing all these numbers and things going up in price. I do believe that in Winnipeg, our just average sale price has gone up, but we're still one of the lowest, if not the lowest in the country for average sale prices. So I think it is still affordable. It's just a little less affordable than it was a year ago. I did want to say too that in the last week, 8 houses expired, and in the past month, 46 homes expired on the market. So that means that they were listed on average for 83 days. And then they didn't end up selling. So there are still opportunities out there for people. I personally found a house with clients 2 weeks ago. It went past the offer date. We wrote an offer. We were able to buy it, get a home inspection, have our finance condition, and it went really well. So there are opportunities out there still, and it's not all overwhelming for buyers. The other thing that was interesting last year and is continuing into this year, cottage sales were way up. They're still up. People are looking for space because of this pandemic. And we can't go on vacations anymore, right? So we're looking to get out of the city and somewhere to get away. So a lot of cottage sales, and then rural sales with a lot of people being able to work from home and want more space. I think the rural sales are going up. So people are moving out of the city as well. This is just my prediction. I think that it's going to remain a seller's market for the next little while, but I do think that it is getting better. I had a house listed in Westwood last week. We had offers last night and we only got one offer on it. So that buyer got a really great deal on a really awesome house in Westwood. So I think it's going to get a little bit easier, but I think it will still be a seller's market for the next little while anyway. That's all I've got. Any questions?
Oh, we may have a question actually. Yeah, just a question here. What challenges, if any, has COVID presented for buyers and sellers?
I think it's just changed it. I don't know that it would be a challenge, but it's just changed. It's changed what buyers are needing in a house. Your needs and your needs have changed. A lot of people need a home office now. They need different things than they used to need. And then looking at homes, you used to be able to bring your friends or whoever you wanted, and we've limited it. Now it's just like 2 people, unless we have special permission to bring dad with us. So it's limited how many people can go through with you to get eyes on the property. But aside from that, for buyers, you have to fill out a health questionnaire, hand sanitize, wear your mask, and it's been okay. For sellers, it's just, I think for some people it's a little unnerving having people come through during COVID, but other than that, we we just make sure that people are following the COVID guidelines and wearing their mask and hand sanitizing, and then the sellers are coming home and just Lysol wiping down the house after the showing. So overall COVID hasn't been that detrimental to real estate, I would say. That's yeah, I don't know. Is that good?
That's fair.
Yeah.
Perfect. Well, thank you, Mandy. So we'll, I think it'll be Jason sharing next.
Yes, thank you. Mike, thank you for inviting Chad and I to be part of this discussion this morning. So maybe just a bit of a bio on myself, since I'm probably the newest one here. Very recently this year, I joined Chad at Ideal Mortgages as a mortgage broker. Prior to this, though, I was an underwriter and then a mortgage specialist at a large investment firm for about 22 years. Now, this investment firm did a lot of good things, but on the lending side, there was really only two options available to a borrower. And if that borrower did not fit into one of those two boxes, then unfortunately I was not able to assist. But now, as a broker, I have access to literally dozens of lenders. And of course, each of them have their own nuances and requirements, but it's all about having options that I really like. But we're not going to be talking about lenders. We're going to be talking about something that is on all borrowers' minds, and that's interest rates. I read an interesting stat earlier this week, and that is that the average mortgage interest rate right now is 2.660%. So that would imply that half of the current mortgage holders have a rate above 2.60%. Now, in the grand scheme of things, this is not a terrible rate by any means. However, given the current rate environment, a lower rate may be available to them. So if you had a current, or if you have a current mortgage and you want to look at a lower rate, there are several things that should be taken into consideration. The first one being, and most importantly probably, the penalty. If you're in the middle of a closed term, you will be charged a penalty by your lender. The fastest way to find out what that is to just call your lender directly. Now, if the penalty is less than $3,000, there are some lenders that will allow this penalty to be added to the mortgage balance. And if the amortization is staying the same and there's no additional funds being added to the mortgage, the lender will then treat this as a straight transfer of mortgage, and there would be some preferred rates offered. However, if the penalty is greater than $3,000, then the lenders need to treat this as a refinance. The interest rate will be slightly higher, and there may be some additional fees. However, I would like to share my screen. This should be fun. Oh, there it is. Can everyone see that?
About to. There we go.
There you go. Okay, perfect. So this was a real life situation where I had a client last week looking to do just that, looking to take advantage of lower interest rates. But we wanted, first thing we do, we wanted to see if it makes sense if he were to pay the penalty and take a new rate elsewhere. So this is one of the calculators that we use in determining that. So for this particular person, their outstanding mortgage balance right now is $340,000. They have a current interest rate of 3% even. They were paying $1,800 a month. And when they called their credit union, they were told the penalty was $2,897. So it's under $3,000, so we can add it to the mortgage balance. And the lender could treat this as a straight transfer because he wasn't looking to add any additional funds. He was in a closed term, of course, with 19 months remaining, and his remaining amortization on the mortgage was an even 19 years or 228 months. So the rates we were able to find for him at the time, the fixed rate option that we found for him was for 2.14% for a new 5-year term, adding the penalty to the mortgage and keeping the amortization at 228 months. His new payment amount was $1,830 a month. Now, this is where we want to look at the net savings, or the savings in interest between now or over the next 19 months. So between now and his scheduled renewal date at the credit union, he'd be saving over $4,400. So that more than covers the penalty. And in fact, once the penalty is factored in, he's saving just over $1,500. So there's an option for him right there. Another option is to look at the variable rate mortgage. Now, the rate we were able to find for him was 1.55%. So that represents prime minus 0.9%. Prime rate right now is 2.45%, minus 0.9, 1.55. Adding the penalty to the mortgage, keeping the amortization the same, his new payment amount was $1,735. Now, what's really significant is the interest savings. Because it's such a low rate, his interest savings between now and his scheduled renewal date is over $7,500, minus the penalty. He'd be saving over $4,600, which sounds very significant, but when you're taking a variable rate, you do have to take into consideration and be comfortable with the possibility and actually the fact that the interest rate will fluctuate over the 5-year term. Something we might suggest is if he were to take the variable rate option, keep his payment, if he's comfortable paying $1,800 a month, keep his payment amount at $1,800. The additional funds that he's paying will go directly to the mortgage balance, pay it down faster, and thereby save him even a little bit more interest over the life of the term. And then when the interest rate does go up, even if it goes up 0.5 point, he's still paying less than had he taken the fixed rate. So these are just options that are available. Both options make sense. It's just whatever they're comfortable with as a borrower. Now I'm going to try and stop sharing. That worked, yeah?
Yep.
Okay, good. So again, if the penalty is greater than $3,000, the other consideration that needs to be taken into account is the equity available that's in the property. Now, existing homeowners are able to access up to 80% of their property value. So let's say, for example, your property is worth $500,000, 80% of that is $400,000. But if your current mortgage balance is sitting at $425,000, unfortunately, there isn't any accessible equity at the moment. So that needs to be taken into consideration. Another one, of course, is credit and employment, but those are all standard considerations in applying for a mortgage. Now, continuing with interest rates, something that I come across a lot is, are ultra low rates always the best? So if somebody comes across a ridiculously low rate, does that mean it's the best one for them? In my opinion, the short answer is no, not always. If such a low rate is being offered, what's the catch? What are the restrictions? Is it too good to be true? Quite possibly. Things to take into consideration, are there additional fees that are going to be charged in order to get that lower rate? And restrictions, when I say restrictions, I mean, are there any prepayment privileges allowed with this ultra low rate mortgage? Can I refinance anytime during the term? Can I early renew anytime during the term? Can I even port or transfer the mortgage from one property to another? Or if I were to pay it out, is the penalty a little excessive? These are all possible restrictions or consequences as a result of a low interest or an ultra low rate. But again, these are just questions that should be asked. You would be explained any of these at the time of application, of course, but sometimes you're just bombarded with so much information, it's easy to forget. But these are some things to keep in mind. And further to interest rates, something that should be asked when you're looking at a mortgage is, what's better for me right now, the fixed rate or a variable rate? And with that, I would like to hand it over to Chad.
Morning, guys. Okay, so I'm going to talk a little bit about fixed and variable rates and just put a bit of a spin on sort of what the connection and what the disconnect between fixed and variable rates are. We're getting a lot of phone calls from clients right now, new buyers or existing clients wondering what they should do. So, at the end of the day, there is a disconnect between fixed and variable. Fixed rates come from bond yields. So bond markets, there's a supply and demand out there in the marketplace that drives the price of a 10-year bond. And I'm going to share my screen here for a second. So what we're looking at here, can you guys see this?
Yep.
Yeah, okay. So what we're looking at here, this is the history of the 10-year bond or various bond yields from 2016 right through to current. And you can see here, as we entered the pandemic, we saw a significant drop in bond yields. So that drove interest rates to historical lows. Now, as from February going into current here, as you can see, we've seen an increase in those bond yields. But what's kept interest rates low to date is stimulus. Our government has been throwing $4 billion a week into the stimulus, into the capital markets, and it's been keeping a lid on those interest rate increases until recently. I think we've got a housing market in bigger markets like Toronto that needs a little bit of cooling. Pulling back on that stimulus and letting those rates rise a little bit. So that's kind of where we're, why we're seeing the increases that we're seeing right now. Now, where are in? Well, that's going to have a lot to do with the level of stimulus the government is prepared to throw into the capital markets. If you look at this bond yield right now, so if one were to try and predict where interest rates are going to go, or get a sense on why they're doing what they're doing. If you look at the Bank of Canada's website, I'm simply on the Bank of Canada's website here looking at the 10-year Canadian bond yield. You can see that the bond yields are trending right in around that 2% mark. So generally, the banks and the mortgage companies that are out there need to see a spread over the 10-year bond at around 1.5% for them to be profitable. Clearly, that's not happening right now. Interest rates are still low. There's about a 50 basis points spread over what the 10-year bond is right now. And that's just being stimulated by government cash being printed into the marketplace at a rate of $4 billion a week. So, the banks are not obviously earning less money right now, but they're being supplemented. So as they reduce that stimulus, interest rates on the fixed rate side will go up. Now, having said that, variable rates are a decent consideration. Leading into the end of the pandemic, fixed rates were extremely low. Variable rates were trading at a similar level. So does it make sense to take a risk on variable rates when you can get a fixed rate at what the variable rate is? And the answer to that, in my opinion, is no. But when you start to see disparity, so the prime rate of lending in Canada, as Jason mentioned, is 2.45% right now. As you start to see a disparity between the fixed rate offerings and the variable rate offerings, it starts to make more sense to look variable. So right now, variable rates are, call it prime minus 1%. So you can get a variable rate at around 1.45, where a fixed rate is around 1.99. So that difference being 50 basis points, a 10-year chart will tell us that over time, you are going to save more money with a variable rate than a fixed rate. And I'm just trying to find a bit of a chart on that. For whatever reason, it is not letting me share the screen. Just a second here.
While you're doing that, Chad, we do have one question.
Yes, please.
For an attendee, if you don't mind. It's either for
Please.
you or for Jason. Just the question is, we see cashback offers from some banks. Is there anything we need to be aware of with these offers?
Jason, do you want me to, am I okay to chime in on that? Yeah. So banks don't give money away for free. There are some, particularly a couple of the retail banks out there that are really big into the cashback offers. And I call them, you use them in a worst case scenario. So a cashback is basically a bank increasing your interest rate and giving you a cashback to take that higher interest rate. The catch is that the interest increase that they're charging you is far in excess of the cash that they're giving you. So if the interest rate increase, if the cash back is $5,000, rest assured they're earning $8,000 to $10,000 on the additional interest component that they're charging you to do that. The second part of that cash back is if you ever break the term of that mortgage, there's various products out there, but generally speaking, you have to pay it back. Some you pay a prorated portion in addition to your penalty. You pay a prorated portion of that cashback back to the lender. And in some, even though 2.5 years may have passed into the term, they require all of it to be paid back. You know, it is, you're locked down like Fort Knox at a cashback mortgage for the entire term of the mortgage. You really don't have any room to manipulate your terms if you needed to.
What kind of variation will you see in rates typically, Chad, if with the cashback offers? Will it be like a couple basis points difference? What will it look like?
Yeah, so they're very different amongst different lenders. The cashback offers right now are actually better than I've ever seen them. I still don't like them. But, you know, call it 30 basis points. You know, when there's a tiered structure, so for 1%, you know, when there's a tiered structure, so for 1% cashback, it might go all the way up to, you know, a 3 or 4% cashback. Yeah, so the, can you see this screen here?
Yep.
Okay, so just a little bit about variable rates and why I think over 10-year periods of time, when the disparity between, at the time of transaction, when the disparity between fixed and variable was 50 basis points or more, fixed and variable was 50 basis points or more, which is what it is. You're gonna win. History has shown us that we'll win with a variable rate over 10-year periods of time. So this is just a point in time in history here, taking us from 2009 to 2018. This purple line are variable rates. The blue line are fixed rates. And as you can see, there's been very few times that variable rate has even touched what the fixed rate is. But it's pretty clear over a 10-year period of time, we're better off variable than fixed. And where you can really mitigate your risk on that variable rate is consider making your payment as if it were a fixed rate, reduce the principal of your mortgage faster. And if prime does go up a little bit, you know, economists are saying that we shouldn't see any real true changes to the prime rate of lending until well into 2022. The US is saying 2023. But, you know, at the end of the day, if you're paying more or paying as if you had a fixed rate, that principal is being collapsed. And even if it does go up 25 basis points, your balance is less. It has less impact. Hopefully that just paints a bit of a picture. There's a real difference between fixed and variable rates and how the mortgage funds are securitized with the major lenders. But, you know, debt in Canada right now is 170% of disposable income, as we've all probably seen in the news. Inflation is, although increased a little bit recently, it's still well within what the expectations are. So there's really no reason to increase that prime rate of lending anytime soon. That's all.
Cool. Thanks, Chad. Did you guys, there aren't any other questions regarding mortgages at the moment. There might be some that pop up as we go, but thank you to both of you for that. And what I'll do is I'll pass the baton right away to Tara and Jessica.
Hello, everybody. So I'm just going to get my slideshow going and share my screen. Okay. So thanks for having us today. My name is Tara Elias, and I'm on the sales team for the Manitoba and Saskatchewan group for IA Financial Group. I've got my colleague, Jessica Johanson, on the call. She's our living benefits specialist. So I'm going to start off today and give you kind of an overview of looking at creditor protection from a consumer standpoint. And then I'll pass it over to Jessica to go over some more fine-tuned details about living benefits. So private insurance, personal insurance versus creditor protection. Here we go. So myself and Jessica on the call today. So one of the things we wanted to touch on is the fact that sometimes in the insurance world, we use a lot of terms that don't make sense to clients. And we forget that when we're sitting with clients. We forget that they don't understand always what terms like death benefit mean, or underwriting, or renewals. So these are terms that I wanted to just put up a slide that kind of went over these terms and how can we kind of change the language so that clients and consumers understand what we mean. So premiums, how much will it cost me? A benefit, how much will I receive in the event of a disability or a critical illness? A death benefit, that one's a little bit more obvious. An elimination period, which is a term we hear a lot with disability insurance. What does that mean? The benefit period, how does that differ from an elimination period? Underwriting, a lot of clients don't know what the word underwriting means. So of course, assessing the risk from the insurance company's standpoint. Convertibility, which is a contractual right of anybody that has a term policy to be able to convert that term insurance to permanent insurance. Renewals, what does that mean? And things like riders, which I'm going to talk about today, which are add-ons to life insurance policies to kind of juice them up. So these are the terms we use in the insurance industry, and it's important to change the language when you're speaking to your clients, so they understand what that word means to them, what these words mean to them, and how it applies to them. So just a little bit of a graphic here that kind of, if you look down at the bottom, there's kind of age periods here, and it kind of highlights what your needs might be in a certain age of your life. So when you're between the ages of 0 and 20, you don't have a whole lot of debt going on that you need covered in the event of your death. You might not be married at that point, so you don't have a dependent or a spouse to think about in terms of extending your lifestyle and covering the debts of the things that you've acquired over the years. So you might only at that age, in that age demographic, be looking at things like final expenses in the event of an untimely passing or a critical illness, which is really, really, of course, possible with a child. When you move into the 20 to 25 years, you start to acquire some debts. You start to work maybe your first, real job, important job. So you got to think about disability, and I like to refer to it as kind of paycheck insurance. And you still have those needs for final expenses and CI. These things never go away, right? These are always risks that your clients will face, regardless of their age group, and so on and so forth. So you can see over the years how it kind of fluctuates in terms of what your clients' needs are and what their insurability needs are. So why choose standalone coverage over what the bank or the lender would offer? Well, personal insurance is underwritten at time of application. To me, that's the most important point. If you're using insurance that the lender or the bank offers, you're asked a couple of very basic questions about your smoker status and whether you've had a heart attack, and that's about it. And then when the claim comes in, then they look at the overall health of the client, decide whether to pay the claim out or not. So that's not ideal. So the insurance companies, whether it's our insurance company or any other insurance company out there at our competitors, will underwrite that application at time of application. So they're assessing the risk ahead of time and then deciding whether to give you insurance or not, so that there's less of that risk at time of claim. Personal insurance is portable. Once you have it, it's yours. So you're not worrying about reapplying for that insurance when you buy a new house or refinance your current mortgage. The ability, of course, to convert to permanent. If you have a term insurance policy that's personally yours, you have a contractual right before renewal. So if you have a 20 or a 25-year policy, before that renews, you have the contractual right to convert it to permanent, which then would take care of your more permanent needs. You, of course, are the beneficiary, not the lender. So when the client passes away, the beneficiary gets the money and gets to decide how to spend it, how to use it. So it may be purchased to cover off mortgages and other debts that the client has. But 20 years, 25 years down the road, maybe those debts have been paid off and you can allocate that death benefit to something else versus it just going back to the bank and them deciding, going back in their pocket. More covered conditions, covering more needs. If you have car loans and a cabin, like Mandy mentioned, a lot more cabins happening these days because there's a lot less ability to travel. All kinds of debts that you have can be covered by personal insurance, all in one death benefit, one face amount. Locking in rates, more affordable premiums. You can do apples to apples-ish comparisons between personal insurance and what the bank and lender will offer. So all kinds of reasons why you would want to look at personal insurance for sure, instead of what the lender offers. There was a special on the CBC Marketplace a few years back that was really good. I encourage you to check it out on YouTube if you have time. This is just kind of a graphic that goes over everything I just talked about. It just kind of lays it out in a comparison chart format about what you would get when you bought personal insurance versus buying it from a lending institution. So these kinds of materials are available from us, and we can certainly pass it along, and as well as a lot of our competitor friends in the industry. So we do have a product that is widely used for clients who are looking to cover their mortgages and their other debts. And that product is called Pick a Term. It's pretty unique to IA Financial Group. There are a few other companies I think that might have something like it now, but it allows you to, instead of buying a form T10 or T20, it really allows you to customize the term of the base life insurance policy to what the client's needs are. So while you can certainly purchase a T25, you actually can purchase any term between 11 and 40. So sometimes people pay up their mortgages faster, or they anticipate loans going on a little longer than the 25 years. There's people out there that had the 30-year amortization. I think I had one when I bought my first house. So there's all kinds of different client needs out there, and the flexibility of Pick a Term and allowing any term between 11 and 40 allows you to really customize that need. And then you can add on the riders that we talked about on my second slide. So riders are, of course, add-ons, things that would enhance a life insurance policy to cover even more additional needs. So the disability credit rider, Jessica's going to go over in a few slides. But that rider is meant to cover your loan payments in the event of a total disability, so that you're not worrying about paying that mortgage or paying for your car loan. That rider will take care of it. And there's all kinds of features that you can choose between on that rider that Jessica will go over. And then critical illness. 1 in 3 people will contract a critical illness. And, you know, sometimes I hear about CI being expensive, and that's because it's used more, it's claimed on more, because people are contracting critical illnesses and surviving them, which really just highlights the need for CI. So we have it available as a rider. That way you don't, as an advisor or as a client, have to write up 2 different policies. You can write up one policy with these kinds of things added on. And you know, of course, we can dive in a little deeper if anyone wants at some point offline to talk about why you would want a rider versus a standalone and vice versa. But we have the customizable needs available at IA Financial Group.
Hey, Tara, just to interrupt you briefly there, I have a question from an attendee. If I have creditor insurance now, can I get standalone insurance and then cancel the creditor insurance?
You can.
Okay.
You can. If you're in the middle of buying a house right now and you're watching this going, oh crap, I think I have to take that insurance because it's going to take a little while to maybe underwrite this application, you can take it just to protect yourself in that short term, and then you can cancel it after the fact once your insurance is approved. And this slide really is just kind of another screenshot of a marketing piece that we have that really highlights the need of personal insurance over what the creditor or the lender or the bank will offer. And it just kind of highlights again, hey, you need to have that application. You need to have your risk assessed at time of application versus time of claim. That's really, really important, because 20 years from now, you could go to make a claim and you may have contracted cancer, or you may have had a heart attack, and now all of a sudden you're uninsurable and that claim may not pay. That's really important. So here's, like I said, another piece that we have that we'd be happy to share if anyone wants it, that kind of highlights this need. And I'm going to hand it back over to Jessica, and she's going to do the rest of the slides. Thanks again, Mike, for having us.
Awesome. Thank you, Tara. So Tara did a great job just kind of from a consumer perspective, highlighting why you want independent insurance. And I'm going to focus in a little bit more on kind of the living benefits portion of that, which sometimes gets missed when we're having this conversation. So with IA, she mentioned we have the ability to bundle in life insurance, disability insurance, and critical illness insurance. We often, like she said, refer to disability insurance as paycheck insurance. But when we're talking about mortgages and lenders, what we're actually doing is covering off a debt payment in the event of a disability. So if I get sick or hurt, I'm going to have my monthly mortgage payment paid for, but it's actually going to go directly to the bank, like Tara said. It's going to be covered, but it's not going to come to me as an individual. So at IA, we have the ability to add on the disability credit rider. In order to qualify for it, you have to be working 21 hours per week. You have to be between the ages of 18 and 59. We can cover anywhere from $300 a month all the way to $3,500. And what's kind of unique about this is the benefit period. So again, going back to that terminology, how long am I going to get paid, or how long is that payment going to be covered in the event of a disability? At the lenders, they will only ever cover you for 2 years, which we know oftentimes if you've had maybe a long-term illness or a little bit more of a serious accident is not going to be sufficient. So with IA, we give you the ability to actually take that benefit period. So how long will they cover that payment out to 5 years or even all the way to retirement, which pairs a little bit better, especially when we're looking at a 25-year mortgage payment. Again, we have something called a waiting period. So how long will I have to wait to get paid? At the banks, it's always going to be either 60 days or 90 days. Ours is similar to that. However, there's a few things that we build in. If you've got hospitalization, day surgery, things of that nature, we'll actually go and take that waiting period away. So you can get paid a little bit quicker on those. So Tara, if you can hit the next slide there. So we mentioned covering not just kind of that specific mortgage payment, which is something that's really kind of neat with this product. We can cover a variety of debts. So it's not, again, tied to that one payment at the lender. We can cover mortgage if you've got a line of credit, commercial buildings, if you have student loans, car, boat payment. We'll actually cover rent as well for up to 2 years if you have someone who doesn't own their primary residence, but they rent it. Vehicle leases, things of that nature. So typically a lot of clients will go in and, they apply for a car loan at the bank. They need insurance on that. Then they apply for the mortgage. They need insurance on that. This is a way to kind of bundle in all those coverages into one policy, one contract, one benefit amount. And again, not have to worry about requalifying if we change lenders, et cetera. So you can really kind of bundle it all in, keep it all in one place, and you have that coverage, for the length of the term that you've selected. So it goes on for a long time. If you can hit the next one there, Tara. So critical illness, this is a separate payment. So we talked about the disability benefit. One other thing I actually didn't mention that I want to highlight when we're talking about the disability benefit is that's going to pay above and beyond kind of your group coverage, your government benefits. So there's something called integration of benefits that happens with disability. That's not something you need to worry about when you're looking at our disability credit rider. You're still going to get your group benefits, you're still going to get your government benefits, and your monthly debt payments are still going to be met. So we've also got critical illness insurance, which can pay in addition to disability, which is kind of neat. So if you're diagnosed with one of these 25 covered conditions, you're going to get a lump sum. So typically when we're at a bank or we're looking at lender coverage, it's going to be tied again directly to that total loan payment. With us, you have the ability, again, to kind of pick and choose. You can have the entire amount covered, you can have a smaller amount covered. But what's unique when we're looking at critical illness insurance independently is if we have that coverage at the lender, as soon as that CI payment is made, no more life insurance exists, no more disability insurance exists. With our coverage, even if your client, claims on a CI, they can still have their disability intact and they can still have their life insurance intact. So we will give you the ability at IA to choose either between 4 illness coverage, which is going to cover cancer, so life-threatening cancer, heart attack, stroke, coronary artery bypass surgery, and a few other kind of benefits under this prevention, which is going to be kind of an apples to apples comparison to what you get at the bank. So 4 major illnesses, or we give you the ability to kind of juice it up and cover 25 covered conditions. So Tara mentioned 1 in 3 people will be diagnosed with a CI in their lifetime. So there's a huge kind of gap in coverage and need for people to have this. And most group plans don't actually cover CIs. So they're, if you're looking at your group insurance, you'll have some life insurance likely, you'll have some disability insurance, but there is no CI coverage, I would say 1 out of 3 times. So this is a super important product to kind of be aware of, a product to have in terms of just kind of what would I want to do with that money if something happened? Would I want to pay off my mortgage? Would I maybe want to, go down to the Mayo Clinic and get treatment? You get to choose when the coverage is yours and it's not tied to the lender. If you can go to the next slide there, Tara, thank you. So this is actually just a quick snapshot comparing our product against what you can get with other lenders. So I kind of mentioned they're going to cover either 3 or 4 illnesses at the other banks. So I actually took the bank names out here. Whereas with us, we give you the ability to cover those 4, or you can cover 25. We know if we're getting coverage at, again, the lender, as soon as that CI payment hits, the rest of the insurance disappears. And it's actually going to be going down as your mortgage goes down. So your benefit amount is tied to whatever your mortgage is currently. But your premiums stay the same, which is not great. So you're paying for, the same premium that you would, even though you're getting less coverage down the road. There's also maximums at the banks. So we, we have certain maximums, but it's more tied to kind of your financial status versus that mortgage amount specifically. So again, critical illness is just a very personal number, talking about what do I want to do with that money if I get sick. Next slide there, Tara. So apples to apples, I mentioned we have the ability to kind of go in and show you what you're getting at the bank. So if you just kind of want similar coverage, you're not really looking at, adding on more illnesses, you don't really care if the benefit amount decreases along with your mortgage, we have the ability to do that. We have the ability to give you decreasing coverage to really give you kind of a side-by-side comparison. However, we never decrease on our life insurance and our CI to less than 50% of the initial face value or death benefit, depending on the product we're talking about. So that means if I start with 300,000 of life insurance coverage, I will always retain 150, even if I'm choosing the decreasing option, which helps keep the cost down a little bit. Or we can kind of keep it more level. We can add on more illnesses and kind of juice it up and give you a real Cadillac plan, because this is your insurance and this is something that you can take with you, you can convert and you can have forever, regardless of if you're changing lenders, you're taking advantage of some of those new interest rates, you're doing a refinance. This is your insurance for life. I think I'm good on that one, Tara. And I think is that it for us? I think that's it. Yeah. So does anyone have any questions?
Yep.
We do have a question. Is there an easy way to determine if my creditor insurance, so I guess the stuff at the bank, right, only covers life or if CI and disability is included?
Yeah, there was a question.
Are we frozen there? Okay. So typically, if you're looking at kind of your lender insurance, there are a few qualification questions. So sometimes when you, like Tara mentioned, it's like kind of a light underwriting that you're getting at the lender at time of application. So they'll ask a few eligibility questions, and then it depends how you answer those eligibility questions. So sometimes you will qualify for the life insurance, but not the other components. So it should be something you would have received kind of when you were going through your mortgage process. You should have some sort of documentation that can help identify that. And then if you chat with your kind of financial advisor, they should be able to have a quick peek and, they're the experts and point you in the right direction in terms of what's covered.
Perfect. And just to clarify, that type of product can only be purchased through a financial advisor, correct? An insurance licensed financial advisor.
So we're talking about kind of our products?
Yes.
Correct. Yeah. So you have to be talking to a qualified financial advisor who is licensed, who can really kind of explain all the benefits, of private insurance. We just did a high level overview, but there's tons of great reasons. Another one is cost. We're oftentimes saving a ton of premiums if we're looking at that kind of individual insurance versus looking at coverage through the lender.
Cool. I don't have any other questions floating around in the question box. Yeah, that was fantastic. Tara and Jessica, thank you for that.
Thanks for having us.
I think our attendees will appreciate that information. It's great context. And yeah, we're coming up to almost an hour. So let's just, I guess, wrap it up, guys. We did a great coverage there of a variety of quite a lot of content and information about the real estate market. And thank you, Mandy, for that. And of course, to Chad and Jason for giving a good overview of the mortgage business, and then to you, Jessica and Tara, for the insurance piece. And I think all of them come together really well. It's rare to have all those pieces of the conversation brought under one roof, virtual one in this case. And so I appreciate that you guys were all able to contribute and participate today. Thank you.
Awesome. Thanks for having us.
Thanks for having us.
Awesome. We'll wrap it up there. Now you know.